Here's a question that has haunted empires for centuries. What do you do when you discover vast wealth beneath your feet? If you're thinking, celebrate, obviously. Well, congratulations. You're about to learn why the Spanish Empire collapsed, why Venezuela went from richest country in Latin America to economic catastrophe, and why the Netherlands, one of the most sophisticated economies in history, literally named an economic disease after itself. Because here's the archaeological evidence we keep finding in the ruins of civilization after civilization. Discovering massive resource wealth is often the worst thing that can happen to an economy. The treasure becomes the curse. The lottery winner goes bankrupt. And economists have been watching this same pattern play out for the last 500 years. So, what is going on here? Let's excavate this pattern with a few key questions. First, what exactly is Dutch disease, and why did the Netherlands, of all places, become the poster child for resource wealth destroying an economy? Second, what's the actual mechanism here? Like, mechanically, step by step, how does finding oil or gold or natural gas take a thriving, diversified economy and hollow it out? And third, and this is the archaeological question, why do we keep seeing the exact same pattern across completely different civilizations and time periods? From Habsburg Spain to 1970s Netherlands to modern Venezuela, why can't we seem to learn this lesson? Cool, so let's start with how this got its name, because it's kind of perfect that the Dutch, who are basically the world champions of careful economic management, are the ones who identified and named their own economic disease. In 1959, the Netherlands discovered massive natural gas reserves in Groningen. And I mean massive. One of the largest natural gas fields in the world, enough to transform the Netherlands into a major energy exporter basically overnight. This should have been pure economic upside, right? Free money from the ground. Instead, by the mid-1960s, Dutch economists were watching in real time as their manufacturing sector started to collapse. The guilder was strengthening, exports were becoming uncompetitive, and traditional industries were shutting down. In 1977, The Economist magazine formally coined the term Dutch disease to describe what was happening. And here's what makes this such a good case study. The Netherlands noticed what was happening. Dutch economists identified the pattern, named it, wrote papers about it, and it still took decades to manage because the economic forces involved are incredibly powerful. Anyway, let's break down the actual mechanism because this is where economic archaeology gets interesting. The pattern is consistent enough across civilizations that we can basically map it out step by step. Step 1. Country discovers massive natural resource wealth. Oil, gas, gold, silver, whatever. Could be discovery, could be a price spike that makes existing resources suddenly valuable. Step 2. Money floods into the resource sector. Foreign investment pours in. Domestic capital shifts toward the resource industry. Makes sense. That's where the returns are. Step 3, and this is where it gets counterintuitive. The currency appreciates. All that foreign money buying your oil means higher demand for your currency, which means your currency strengthens against other currencies. Now, if you're not thinking this through, that sounds great. Strong currency? Who doesn't want that? But here's the thing. A strong currency makes your other exports more expensive to foreign buyers. Let me give you a simplified example. Say you're a Dutch manufacturing company making, I don't know, industrial machinery. Before the gas discovery, you could sell a machine to Germany for what amounts to $10,000. Then, the guilder strengthens by 30%. Now that same machine costs German buyers $13,000, even though nothing about your production changed. You just became 30% more expensive because of something completely unrelated to your business. Step 4. Traditional export industries, manufacturing, agriculture, tourism, whatever, start becoming uncompetitive. They can't compete on price anymore because the currency is too strong. Companies start shutting down. Workers lose jobs. Step 5. Resources shift even more toward the booming resource sector, because that's the only part of the economy that can sustain the strong currency. You get this vicious cycle where the resource sector crowds out everything else. Step 6. The economy becomes dangerously dependent on a single commodity. And here's where the archaeological record gets really dark, because we know how this story ends when that commodity price eventually crashes. Now, let's dig into the historical record, because this pattern didn't start with 20th century oil. The Spanish Empire is basically the cautionary tale that everyone ignores. In 1545, the Spanish discovered the Potosi silver mine in what's now Bolivia. This wasn't just a big discovery. At its peak, Potosi was producing about 60% of all the silver in the world. The Spanish treasury was literally filling up with silver from the New World. And what happened? Spain went from being one of the most powerful empires in history to economic basket case in about a century. The Spanish economy never developed manufacturing capacity because why would you bother making things when you can just buy them with silver? The silver flooded in. Spanish prices inflated. Spanish exports became uncompetitive, and traditional industries withered. By the time the silver started running out in the 17th century, Spain had no industrial base to fall back on. The wealth had destroyed the economy's ability to create wealth. The archaeological evidence is stark. Spain went from global superpower to economic backwater, and it took centuries to recover. Anyway, once you know the pattern, you start seeing it everywhere in the economic archaeological record. It's almost eerie how consistent it is. Venezuela, massive oil reserves, became richest country in Latin America by the 1950s. By 2020, people are literally starving, and the economy has collapsed by about 80%. Classic Dutch disease combined with catastrophic governance. Nigeria, Africa's largest oil producer. Despite decades of oil wealth, manufacturing as a percentage of GDP actually declined. The oil wealth crowded out everything else. Saudi Arabia recognized the pattern and has been desperately trying to diversify with Vision 2030, because they've watched what happened to other oil states and know the pattern. Iran, before 1979, oil wealth, strong currency, agriculture sector collapsed, became dependent on food imports. When oil revenues dropped, crisis. And here's what's fascinating from an archaeological perspective. These countries all knew about Dutch disease. The economic literature existed. The Spanish example was right there in the history books. And yet the pattern keeps repeating because the economic forces involved are so powerful that even knowing about them doesn't necessarily help you avoid them. Now, I know what some of you are thinking. What about Norway? Because Norway discovered massive oil reserves in the North Sea and somehow didn't destroy their economy. And you're right. Norway is the great exception, but it's the exception that kind of proves how difficult this is to manage. Because Norway had to take extraordinary, almost unprecedented measures to avoid Dutch disease. They created the Government Pension Fund, basically the world's largest sovereign wealth fund, and legally required that oil revenues go into this fund rather than into the general economy. They limit how much they can withdraw from the fund each year. They maintained strict capital controls. They kept investing in education and traditional industries even when oil looked like the easy answer. Essentially, Norway looked at the archaeological record, saw the ruins of every other resource-rich economy, and said, "We're going to do something different." And it worked. They're one of the only countries to discover massive oil wealth without destroying their economic diversity. But here's the thing. Norway was already a wealthy, well-governed, sophisticated economy with strong institutions when they found oil. They had the administrative capacity and political stability to resist all the easy temptations that destroyed other countries. And even then, it required sustained political will across multiple governments over decades. Most countries aren't Norway. Most countries are more like Nigeria or Venezuela. They discover resources when institutions are weak, governance is poor, and the temptation to just spend the money is overwhelming. Cool, so let's talk about why we keep seeing this pattern despite knowing about it. Because this is where economic archaeology gets a little depressing. First, there's the basic political economy problem. Resource wealth creates incredibly strong incentives for short-term thinking. If you're a politician and oil prices are high, spending that money now gets you votes now. Saving it for the future, maintaining other industries, managing currency appreciation, all that stuff is politically difficult, and the benefits are abstract. Second, resource wealth tends to correlate with weaker institutions, not because of some inherent characteristic of resource-rich countries, but because easy money reduces the need for complex institutions. Why build a sophisticated tax system when you can just sell oil? Why develop manufacturing when you can import everything? The resource wealth allows countries to skip steps that actually build institutional capacity. Third, and this is the really insidious part, Dutch disease is hard to see happening in real time. When oil prices are high and government revenue is flooding in, it feels like prosperity. The currency being strong feels like success. The manufacturing sector declining happens gradually and affects different people than the ones benefiting from resource wealth. By the time you recognize you have Dutch disease, you're often already deep into it. And the political economy of fixing it, deliberately weakening your currency, managing resource revenues, supporting declining industries, is incredibly difficult. Anyway, let's bring this to the present day, because the pattern is very much still active. Look at what happened to oil-producing countries during the COVID-19 pandemic when oil prices briefly went negative. Countries like Russia, Saudi Arabia, and Middle Eastern oil states suddenly faced fiscal crisis because they'd allowed their economies to become so resource-dependent that when the resource faltered, everything faltered. Or look at Australia's mining boom in the 2000s. Massive Chinese demand for iron ore and coal. Prices skyrocketed. Australian dollar strengthened significantly. And what happened? Australian manufacturing employment dropped. Traditional export industries struggled. The economy became increasingly concentrated in resources and real estate. Classic Dutch disease, even in a wealthy, sophisticated economy with good institutions. The cryptocurrency boom in countries like Venezuela provides an interesting modern variation, people trying to escape the consequences of resource dependence by adopting a different kind of commodity money. It's not working, but it's the same pattern, looking for the easy answer instead of the hard work of economic diversification. So, what's the lesson from all this economic archaeology? I think there are a few things. First, resource wealth isn't automatically bad. Norway proves you can manage it. But it requires extraordinary institutional capacity, political will, and long-term thinking that most countries simply don't have. Second, the pattern is consistent enough across time and civilizations that we should take it seriously. When Spain, Netherlands, Venezuela, Nigeria, and Iran all follow basically the same trajectory, that's not coincidence. That's deep economic forces at work. Third, and this is maybe the most important point, easy money is dangerous precisely because it's easy. The Spanish silver, the Dutch gas, the Venezuelan oil, it all looked like pure upside. But wealth that comes from the ground doesn't build the institutions, skills, and economic diversity that create sustainable prosperity. It shortcuts the hard work, and history suggests those shortcuts usually lead to ruin. The archaeological evidence is pretty clear. The civilizations that built lasting prosperity did it through diversified economies, strong institutions, and the boring, difficult work of developing human capital and productive capacity. The ones that relied on natural resources? Well, we're still excavating their ruins. Now, does this mean every country with natural resources is doomed? No, that would be oversimplifying, and if you've watched this channel before, you know I'm allergic to oversimplification. Norway exists. Botswana has managed diamond wealth reasonably well. It's possible, but the base rate is pretty bad. More countries follow the Venezuela trajectory than the Norway trajectory, and that should make us think carefully about what creates real economic prosperity versus what just looks like prosperity while the resource wealth is flowing. Anyway, I'm sure this will make both free market advocates and resource nationalists angry, which probably means I'm somewhere in the right zone. If you enjoyed digging through the economic ruins of fallen empires, that little like button below helps the algorithm show this to other people who enjoy watching civilizations make the same mistakes repeatedly. And if you've got examples of other countries navigating Dutch disease, either successfully or catastrophically, drop them in the comments. The archaeological record is always growing.